I was thinking about the protests in France lately, the protesting about raising the retirement age. And then yesterday, House Speaker Kevin McCarthy was visiting the NYSE to politic for his side of the debt ceiling debate and the budget fight. And we've talked about growing social unrest in the last 6 months or so from unlikely places like China and Iran, and you're seeing the people protesting in the streets in France. And obviously we had our event in the States in January 6th that we're still dealing with. But we do have a lot of concerns out there and a lot of issues that people are focused on. And one of them is, given the economic difficulties we've had over the last bit of time, economic security. And at the same time, we have a population that we talked about a couple of weeks ago that's aging rapidly. So today I want to talk about these two issues, aging and economic security. And throughout history, people have faced uncertainties brought about by unemployment, illness, disability, death, and old age. These are the threats that people have to economic security, and they're becoming bigger issues right now, given the volatility that we've had in the economy over the last 15 years or so. So I think you add to that the great financial crisis, the pandemic, the war in Ukraine, and you've had even additional strains. Now you have inflationary pressures coming back, which we haven't had to deal with. Throw in AI and ChatGPT for potential threats to the livelihoods of so many, and many people who are not even prepared for what's coming. So we have more problems than we have time or money to solve, quite frankly, and our elected, and certainly more than our elected officials seem capable of addressing. And then add to that, today I read that nearly 1 in 5 people in the US age 59 and older say they don't have a retirement account, and 27% said they haven't set aside anything for their later years. An additional 5% of people over age 59 or older said they can't afford to contribute to their retirement plans at all, leaving them with pretty significant gaps in where they're going to be as they get into retirement. So today I'd like to talk about the world aging, share a brief history of economic security from the United States perspective, and what are some of the lessons we can learn from what's going on in France. So let's jump right in. So I showed this chart a couple of weeks ago, and two elements of the chart really stand out. One is that the purple bars, which is 65 and older, is expanding, and the other is that 15 years and younger is declining. And that is a bad setup when you have more people going into requiring support from the system than are paying into the system. And that's what the under 15-year-olds are, is they're the guys who pay for everything that we're going to be doing over the long term. So that's one problem. The other problem is when a lot of the governments were setting up programs, the life expectancies were very different. And when you just look at the life expectancy change from 1900 to today, you've doubled the life expectancy. If you look at where we are from even 1980, you've seen 30% increases. So big population aging at a very alarming rate. And that's something we want to be concerned about because of this screen, which is the age dependency ratios are creating a math problem. And age dependency is the people under 15 and over 65 who are supported by the working population, who are contributing to the government's coffers to support it. So these are not going in very positive directions, as you see the chart starting to angle up for France and the US. There's a big problem in a lot of the countries, not just in Europe. All of Europe has similar dynamics. China and Japan also have the same charts, and that's not a great setup for where we are. It's part of the reason why some of the advances in technology and robotics are positives, but we're just not prepared for this. And then the other question is, if you replace all the workers with robots, how do you pay for the taxes, and where do you get your tax revenues from? So I want to jump into a brief history, and it will be a little bit longer than brief because I can't help myself. But when you go back originally in ancient Greece, olive oil was viewed as very nutritious and could be stored for long periods of time and to provide for themselves in times of need. The Greeks stockpiled olive oil, and this was their form of economic security. You moved into the medieval Europe, and you had the feudal lord who was responsible for taking care of the serfs. And then at the same time, the serfs had had job security as long as they were healthy enough to work, and the feudal lord had his security because he had the serfs doing the labor for him, and it was a symbiotic relationship unless you were a serf, I guess. At least you got your work, but the conditions were not great then either. You moved to the Middle Ages, and charity and family became a big source, and the charity as a formal economic arrangement really came into being then, but family members and relatives really started to pick up the slack, and it was really the source of economic security for the aged and infirm. So that moved us to where the US is. And so for most of the time, you really relied on a couple sources. It was labor, family, and charity, and assets were your real security. And as societies grew and became more complex, both economically and socially, you had to create some changes. And the other thing that happened during this time was people moved from farms to the cities, and industrialization came over, and businesses started to take form, and it was less of a trading economy in terms of less of a farming economy and more of an industrial economy. And that's when you start to see guilds and fraternal organizations starting to come in, the forerunners of trade unions. But when you get into the United States, it's got a very interesting history on schemes for Social Security. And we brought over the European one, the poor laws out of England. That was what we were looking at originally. But when you go back into it, Thomas Paine is said to have proposed the first scheme for Social Security in the US. It was a pretty cool plan. It called for the creation of a system whereby those inheriting property would pay 10% inheritance tax to create a special fund, out of which a one-time stipend of 15 pounds sterling would be paid for each citizen upon attaining age of 21 to give them a start in life, and annual benefits of 10 pounds sterling paid to every person aged 50 or older to guard against poverty and old age. It didn't take off, but it was a pretty good idea. Following the Civil War, though, there were hundreds of thousands of widows and orphans, and hundreds of thousands of disabled veterans. And they were able to receive, widows and orphans could receive a pension equal to the amount which would have been payable to the deceased soldier if he had been disabled. And war pensions were a real asset for people because as these guys, they could draw their pension until they died. So a lot of women married old guys and were able to take their pensions. And in fact, Civil War pensions in the US were paid to surviving widows of veterans as late as 1999. Confederate soldiers and their families were barred from receiving the pensions, as were other segments of the population. The first company pension plan was said to be introduced by a guy named Alfred Dulles, who for his company, which was a builder of pianos and organs, and his plan was to withhold 1% of workers' pay and place it into a pension fund, which he would add 6% interest each year. He viewed providing for older workers as a business cost, unlike others, arguing that his company had to provide for the depreciation of its machinery. He should also provide for the depreciation of his employees. The plan failed, and so did the company, as it went out of business. And the reason it failed was people didn't want to stay as long as it would take to get their money back. Then you fast forward, and Huey Long proposed a wealth share in the 1930s, a program called Share of Wealth. Called upon the government to guarantee every family in the nation an annual income of $5,000 so they could provide for the necessities of life, including a job, a home, a radio, and an automobile. That was pre-TVs. He also proposed limiting private fortunes to 50 million, legacies to 5 million, and annual incomes to 1 million. Everyone over age 60 would receive a pension in old age. He wanted the government to confiscate the wealth of the nation's rich and privileged. So I guess history does repeat itself with programs, as many today's politicians might have been back in office then, given their age, and we're looking at that kind of a plan. But really, the first Social Security came in 1935 with Roosevelt, with the Social Security Act, and we've made adjustments to it since, but it's still not where it needs to be, and it really provides for about 33% of income for people. So what are the lessons we can learn? What's going on in France, and what are the lessons we can learn from it? The way the pension system works in France, and I'm not an expert on pensions around the world, I'm actually a student of this as we go through things, but Mitterrand lowered the retirement age to 60 to fight unemployment. What was interesting is his idea was if you got the older people out of the system, the younger people would come in and backfill the jobs, but it didn't work. The people they didn't get the employment shift that they thought. Actually, it was a time, if you remember back in the early 80s, unemployment around the world, particularly in the developed world, was quite high. And he thought this would actually spur things along. It actually created more unemployment, but it also created what is called the culture of early exits that still exists today in France. And if you ask people in France what they think the right expected retirement age is today, they would say 60.4 years. In most of the rest of the world, they say it's 65 to 70, and it's expected to go up. But pension benefits there are taxed at 28% and don't cover the cost. Yet people don't want to fix the system. So sooner or later, the thing's going to break. And that's what they're really trying to focus on. I mentioned they cover about 60% of workers' costs. Back in 2010, Sarkozy, after every other president tried to raise it, got it raised to 62 after a big fight. And now Macron's seeking to get it to 64, and you're seeing the challenges there. So this is a real fight, but I don't know how people think about math, but if you don't have people paying in, you don't have people working extensive hours to cover the cost, and you have an age problem that's going on, the government's going to have to step in, and yet we're at a tough spot for government. So why are governments pushing for reform right now? And just to give you a little bit more background, China proposed some changes to their pension system in the last month. Japan is proposing changes to their system as well. It's not a French problem or a US problem, it's a global problem. And it's because we have worsening demographics, we have rising interest rates, we're going through a massive cost of living reset after moving off of zero interest rates, and the government coffers are drained, and they have so many strains on them right now. How do we deal with this while we're still trying to bring back our budgets into more normal bad setups given the crises we've had recently? So I think the lessons from France are it's much easier to lower a retirement age than it is to raise it for politicians. But it also costs a lot more over the long term, and we have an age population problem that's not supportive of it. So if you think about it, if they started to raise it back in 1995 even and gave them 13 years of retirement at age 60, you would have spread the burden out over 28 years on millions of workers and had plenty of time to adjust the system. And you could have done it on a graduated increase, which would have set them up better. I also think that, what you need to do is governments need to act, and they haven't been able to move the way they should. They're being way too slow. So I think what you're going to see is the only solution to this really, in my view, is an adjustment to taxes that have to go up in most countries to deal with this. You have to get government to spend better, and you have to actually have people working longer and into the system for more time. And to do that, we have to give better job skills and other issues to deal with the younger people. And Dave Kroom at the event yesterday afternoon, which was, for those who weren't there, it was a phenomenal event. Thanks to Philip Benjamin for hosting and for the panels for their comments. But one of the things that Dave mentioned was the fact that we have a problem in Seattle and elsewhere around the US with young people getting addicted to opioids and other things that are keeping them out of the workforce. And the Brookings Institute came out with a paper on that today. And it's a significant problem that's actually growing pretty fast. So we have real issues with the labor force, the labor dynamics. You have issues with inflation that are going to fight against this. And we do have a responsibility to take care of our own in the system, and we're just not doing that now. So I'm going to stop here. I think there's a real issue. We're going to have a budget fight in the US that we shouldn't be having. We should have a better approach to dealing with this. We should be trying to rein in some of the spending and get our budget right. We have to bring down the debt loads and the deficits to better manage it. We have to do this in a gradual fashion so that we can take care of those that need to be taken care of. So, Mark, I'm going to stop there and open it up for comments and discussion. Criticism's welcome too.
And jokes and snide remarks. So
Always welcome.
Yeah, I bet you do.
Yeah, Michael, that's a great point in the chat about their expected retirement age was not anywhere near. So the system can't support itself the way it was designed. Michael Hammer had a comment in there that Social Security was, the official retirement age was 65 back in 35. But the life expectancy was only 58. So.
Retire.
Go ahead, Saba.
Well, it was designed not to pay out. It was designed to pay for a few, not a lot. So,
Stephen, based on the trends that are unfolding right now in terms of longevity of people and where the pensions are, what would make the system solvent? What age retirement or what level of taxing would make it solvent?
the question. I don't know if everyone heard. The question was, what age would make it? What would fix this problem in terms of age and all that? I think there's a couple of things. I think we're going to have to. I think you have to do that on an actuarial basis that adjusts with the life expectancy is increasing, and that's what didn't happen for a long time. Is when most of the plans, particularly in France, they went the other way, right? You have life expectancy expanding, and you cut the time in the system. That doesn't work. So we actually have to either work in the system longer or pay into the system higher, or reduce benefits. So you don't have that many choices. So this is a math problem. It's not a it's not a. ChatGPT could probably figure this out pretty quickly, but I think there's only so many levers you can pull. Michael?
Yeah, Stephen. So
I can't hear you.
raising, oh, hang on a second.
Mark, can you hear Michael?
How's that? Is it better?
Yeah, go ahead.
Okay. So the problem with raising the retirement age is that people who work in fields where they're doing hard manual labor, they just can't keep working that long.
I think one of the issues, that's where technology can help. And it has to help. And you're seeing that with companies, and Amazon gets a lot of criticism, but what they are trying to do in the warehouse, what a lot of companies are doing in the warehouses is, exoskeletons and other things that can help people work longer. It's not an ideal setup, but it is a problem, Michael. You're right, that you have to match up what people are doing to what they're physically capable of. It's been a problem throughout history. So we have to find a better way to do that. There are areas you can help, and there are areas you can. And that's what we have to focus on.
Other comments, questions?
Yes, Stephen, as you studied this, what country is actually addressing this in the right way, do you think? The pension funds and their retirement programs.
I don't know, because I think every country's so different in how their economies work and what drives their economies, that it's hard to say one's better than the other, because it might only be best for them. A lot of it depends on, one of the things that's really hurt retirement is the breakdown of the family structures that we've had, because divorce is expensive. It reduces the net worth of two people that were counting on each other to take care of each other in retirement. Those things all add up. So I think there's a lot of factors. There is probably one or two countries in Europe that are pretty good at it, and one or two countries in Asia. And I'm blanking on which one it was in Europe that had a good one. I think Singapore probably is viewed as one, and I'm not clear on what they do there, but I think they were viewed as one that was pretty good.
Okay,
Other
thank you.
questions?
To follow up on that, Germany had the discussion about the pyramid of demographics in the last decade or last 2 decades. And in terms of contributing to the system, and Germany is one of those societies that have a very fast aging society, they relied on immigrants, Turkish immigrants, and created the system that would allow immigrants to be embraced by the society, simultaneously contributing to their social security system and bringing the new workforce at different age to the system. So that's one of the examples. Unfortunately, in this country, the discussion about the immigration system focuses pretty much on how not to allow people to get to the country. Thank you.
I agree with you, except the last part. I think we want to not allow the wrong people in, but we let them in, and we don't allow the people we need in. An effective immigration policy would go a long way to helping solve a lot of the problems in the U.S. financially, but for most countries it would. But you're right. It's the debate is completely wrong right now on immigration, which is something we've talked about doing a deep dive on for some time.
Up on that,
Sean, you have great experience in this area, having worked with the pension plans. You live with this for 10 years. Do you want to share any thoughts that you have on what we could do to solve this?
Well, I think what we found in the city of San Jose when we were working on those pensions and trying to slim down the unfunded liabilities, that the needle that really moved the lever the most was extending the working age so that people were contributing longer. Our proposal that went to the voters was to go from 50 for police officers up to 57, and for office workers it was to go from 55 up to 67. I think it was, or 63 or 2 to match the Social Security. And with the actuaries, that was pretty much the only way to really reduce the unfunded liabilities. Even, trying to improve returns, adds at the margin. You're able to move the needle a little bit there. Trying to increase the contributions becomes almost unsustainable for the sponsoring entities. So you really just have to work longer and withdraw for less. We did look at Canada. We felt that Canada had the best governance structures for managing the pension funds, and their pension funds were generally fully funded. They're at discount rates of around, I think it was about 4%, versus say the US that at that time was probably 8. Now more like probably 7.5. Those are some of the things that we would look at when we were examining that issue. Canada and Australia. Australia also had a very interesting system with the superannuations, where it's kind of like our 401k, but you can take it with you between different employers very easily. And the employers can contribute, quite aggressively to like our 401ks. That was also very interesting.
Thank you. Very helpful. The one of the big Canadian pension plans has 330,000 people in their system, and their retirement age, the people started working 3 years less and were living 5 years longer in retirement. So if you think they're paying in 3 years less and taking benefits for 5 years longer, it's bad math. It's unsustainable. So they have to make adjustments there. The other challenge is, do governments then take on more risks than they want to take on, or sponsors take on more risk? And we know what happens when you stretch with risk over a reasonable period of time. Usually things don't work out.
Well, isn't it? I think it should be, you made a comment yesterday, you may want to share it here, that the pensions may have their worst year this year.
Yeah, so the pensions, if you look at the prototypical pension plan of 60/40 pension plans, which a lot more of them are still 60/40 than you would think. Of course, a lot of them have evolved to add a lot more asset classes, but many of them are not there. And that was the worst year for a 60/40 pension plan since 1937. And there's been about, I think it was either 5 or 6 years since 1900 where both stocks and bonds were negative at the same time, which is very unusual for pensions to be in a situation where they lose money on both of those two major asset classes at the same time. So that's another thing that puts them under a little bit of stress right now. Of course, they do use actuarial smoothing, 5-year smoothing. So that does give them a little bit of help in terms of balancing the load. The other thing I would also add was that we did, to gentleman's comment earlier about longevity and how long you can work. We did run into some studies on that with the police that, well, you know, how long do you want your police officer working on the beat here? Do you want a 57-year-old police officer chasing after a 23-year-old criminal? And that may not be such a good end result. So there are some other complicating variables there. And one of the ideas was that perhaps, you know, these individuals tend to be well-educated. Most police officers, you know, are college degree holders and, you know, obviously have a strong civic interest. And so San Jose was trying to see like, hey, can we move people that are later in their career into other areas of city government to finish out their career? And that was something that they were also looking into to try to figure out. So, I mean, there's just a lot of little moving parts for these systems.
They could also double up on their pensions though when they move around too, if they go back into another area of government. So you get 2 pensions for people, which becomes a bit of a problem.
Yes,
For government,
that usually makes the newspapers when you have someone that's getting a pension, that's a healthy pension, and then, you know, drawing a second pension, working on collecting a second pension. That does happen.
Michael Hammer?
So, one point is private sector pensions have been declining in the US. So as a percentage of people who have pensions, public sector employees are really the ones who are getting pensions these days. And the other point is Social Security hasn't been intended to be the primary source of income for retirees. So there's an issue there where people just aren't saving enough on their own.
Yep.
Yeah, I'd agree
The
with that.
fall of government, the fall of corporations and move away from defined benefit plans has definitely been a factor in changing the way people view retirement and save for it. And, you know, companies just got away from it. And it's been an issue. The idea of the 401k plan was a good one, but getting people to contribute the right amounts and consistently do it is the problem with that. And as soon as problems occur, people tend to pull back and it sets them back considerably. And young people right now in the gig economy don't even have a setup for this. So we really have to think more deeply about what we're doing for the world we're in today, as opposed to the world we were in 100 years ago when we set up these plans. And governments just have been terrible about adjusting to it. So the tyranny of the urgent takes over every time with governments. They focus on what's right in front of them and kick the can down the road on anything they can because of the election cycles. And that's just a fact of life that we have to deal with. But sooner or later, you're going to need a courageous leadership that's going to give the right answers and tell people they're going to be a one-termer, but they'll tell people what they need to do and hopefully get us on the path to do that.
So we're at the 8:30 mark almost. Any last comments or questions?
I would say one other thing that we always did try to emphasize with employees, you know, when I was a pension fund CIO, was when we had new onboarding of employees, we tried to get them to auto enroll into their 401k. You know, you'd be surprised at how many people are not really financially literate and really don't understand that, you know, that compounding effect of that investment. And it does take quite a bit of education to get them to start the 401k and get going. And so we did make a proposal to make it where you had to opt out of rolling into the 401k. And that was rejected, you know, by the labor unions. Didn't want to have that because, you know, it's a smaller check for employees and what have you. So you know, that's we always did emphasize that, you know, pension is one leg of the stool. You know, hopefully you have a strong 401k. Hopefully you are contributing to Social Security. Not all pension holders do contribute to Social Security. CalSTRS would be a very famous one. You know, the teachers union does not. You take either your pension or Social Security, but you don't get both. The fourth would be, you know, having your excess savings as well. You know, other investments. And we always really try to do a lot of education on that for younger people that were coming in that really may not be aware of those variables.
I think they should make it a course in high school too. not wait till college to get people financially literate. I think you have to start at an earlier age. I think in junior high or, the teen years, they should learn how to budget and have a checking account. And then when they get into high school, they should start learning how to invest and how the markets work and things like that. They need better financial literacy. They also need to know the government's not going to step in all the time. They're not going to be there for them when they need them if they don't do it on their own.